Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5, one idea at a time. I'm your guide here at AlgoBot, and today we're exploring an expert advisor called Directional Coherence Emergence. This one is built from a single original idea borrowed from physics, a way of measuring how ordered or how random a market's recent movement really is. By the end of this video, you'll understand the custom order parameter that drives it, how it decides when a directional regime is forming, and how it manages each trade. Remember, everything here is educational information only and not financial advice. Let's get started. So what exactly does this expert advisor do? Directional Coherence Emergence is a first principles system, meaning it isn't built on a traditional indicator like a moving average, a band, or an oscillator you might already recognize. Instead, it's built on one original idea, an order parameter that describes the sign sequence of recent bar returns. Here's the concept in plain language. Every time a bar closes, the strategy checks whether it closed higher or lower than the bar before it, and records only the direction, a plus or a minus. Over a window of these directional signs, it counts how many times the direction flips back and forth. A purely random market flips about half the time. When flips become rare, price is moving in long, coherent runs, and the strategy calls that an ordered regime. When flips are everywhere, the market is choppy and disordered. From this, the strategy builds a single number it calls coherence, which sits between -1 and +1. Values near +1 mean strong directional order. Values near 0 mean no real structure. Values below 0 mean the market is chopping back and forth. The key insight is that markets breathe between order and disorder. The strategy doesn't simply want order to exist. It wants to catch the moment order emerges, rising up through a barrier that the strategy calibrates for itself from the recent behavior of the coherence signal. Because that barrier floats, the approach adapts continuously to any symbol and any time frame, with no hand-tuned levels. This makes it best suited to traders who are curious about regime-based, systematic thinking, and who want to study how a purely combinatorial measure of market structure can be turned into entry and exit rules. As always, this is for educational purposes only, and trading always carries the risk of loss. Let's walk through the exact logic the expert advisor follows, step by step. Everything happens once per closed bar, so the strategy is patient and only acts on finished information. First, on each new bar, the strategy records the closing price and updates its coherence measurement over the most recent window of bar return signs. By default, that window is 20 signs, though it can range from 8 to 60. Second, it builds its entry barrier. Rather than using a fixed level, the strategy looks back over a trailing window of its own coherence history, 60 values by default, and calculates the average coherence and how much it varies. The barrier is set at that average plus a multiple of the variation, controlled by a parameter called ThresholdK, which defaults to 0.6. A higher K makes emergences rarer, demanding stronger order before acting. Third comes the entry itself. The strategy watches for emergence, the moment coherence was at or below the barrier on the previous bar and has now risen above it. That crossing is the tradable event. To decide direction, it looks at the net displacement of the window. If price finished the window higher than it started, the emerging order points up and the strategy signals a buy. If it finished lower, the order points down and it signals a sell. So the strategy always trades with the newly formed direction, never against it. Fourth is risk. The stop-loss distance is a fixed multiple of the average true range, a raw volatility budget, set at 1.6 times the ATR by default. The profit target is more interesting. It starts from a base multiple of ATR, 2.4 by default, and then stretches according to how strong the order was at entry. Strongly ordered moves are given more room to run, while weaker ones are kept tighter. Finally, the exit. Beyond the fixed stop and the stretching target, the strategy also cuts a position early if coherence collapses back below 0. The reasoning is that a run which stops being coherent has spent its directional energy, so there's little reason to keep holding. Together, these rules form a complete loop. Measure order, wait for it to emerge, trade with it, and step aside once it fades. And remember, every part of it is presented here purely for education. Let's look at the actual MetaEditor code that makes this work. At the top, we have the input parameters. CoherenceWindow, defaulting to 20, sets how many bar return signs are used to measure run coherence. Adapt look back, at 60, is the trailing window over which the coherence signal's own average and variation are taken. ThresholdK, at 0.6, sets the barrier as the mean plus K times the standard deviation. Then ATR period, StopAtrMult, and TpAtrMult govern volatility and the stop and target distances, followed by lots and the magic number that tags the strategy's own trades. Now the heart of it. The variable named emerged is true only when the previous coherence was at or below theta, the barrier, and the current coherence has risen above it. That is the emergence event. When it fires, and the net displacement is not zero, the strategy reads the ATR and computes a stretch factor of 1 plus the positive part of coherence. The stop distance is ATR times StopAtrMult, and the target distance is ATR times TpAtrMult times that stretch. Then the direction. Look at this line. If net is greater than 0, the emerging order points upward, so it calls open trade with a buy order. Otherwise, net is negative, the order points down, and it calls open trade with a sell. Inside open trade, you can see how the levels are placed. For a buy, the stop sits below the entry and the target above. For a sell, the stop sits above and the target below. Finally, trade.buy or trade.sell sends the order with the chosen lots, stop, and target. That's the entire trading core, both long and short, in just a handful of lines. Now let's bring it all together on the chart. On the lower panel, you can see the strategy's own creation, the directional coherence signal, swinging between -1 at the bottom and +1 at the top. The gold dashed line is the emergence barrier the strategy calibrates for itself, and the red line at 0 is where order is considered lost. Watch the opening candles. Price is drifting sideways in a tight, indecisive range. One bar up, the next bar down, then down again. This is exactly the choppy, disordered condition the strategy is built to sit out. Down in the subpanel, the coherence reading is low, even dipping below 0, telling us the sign sequence is alternating close to random. No trade here. The strategy simply waits. Then something changes. A run of higher closes begins to string together. Each new candle closes above the one before it. And because the direction stops flipping, the coherence signal climbs quickly and pushes up through the gold barrier. This is the emergence event. Because the net displacement across the window is positive, the newly formed order points upward, and the strategy signals along. You can see the buy entry marker appear right there, as order is born. From that point, the run keeps its shape. Candle after candle prints higher, the coherence reading holds up near the top of its range, and price advances steadily toward the projected target. Remember, that target was stretched wider precisely because the order at entry was strong. As price reaches the take-profit marker near the peak, the long position is closed for a completed move. That's our first sequence. Order emerged, the strategy joined it, and it exited into strength. Now watch what happens at the top. The upward run stalls. The first down candle prints. The coherence signal dips as a flip enters the window, and the earlier order fades. For a moment, the market is undecided again. But then a fresh run forms, this time to the downside. Consecutive lower closes stack up, flips become rare once more, and the coherence signal climbs back up through the gold barrier. The difference now is direction. The net displacement across the window is negative, so the emerging order points down. The strategy signals a short, and the sell entry marker appears as this new, downward order takes hold. From there, the short trade mirrors the first. Each candle carves a fresh low. The coherence stays elevated because the down run is clean and coherent, and price slides toward the downside target. When it reaches the take-profit marker, the short is closed for a completed move. Two trades, both taken in the direction of a freshly emerged order, one long, one short. And in both cases, the strategy stepped in only once structure appeared, and stepped aside once the target was met. It's worth noticing what the strategy never did. It never tried to pick the exact top or bottom. It never faded the move or guessed at a reversal. It waited for the market to reveal a coherent direction, measured by that alternation count, and then went along with it for as long as the order held. And had coherence collapsed back below the 0 line while a position was open, The strategy would have cut that trade early rather than waiting for the stop, on the logic that a run which loses its coherence has spent its directional energy. That reward-to-risk relationship matters too. With the stop set at 1.6 times the ATR and the base target at 2.4 times before any stretch, each trade is structured to aim for more reward than the volatility budget it risks. Of course, not every emergence leads to a clean run like these, and losses are a normal part of any strategy. This illustration simply shows the logic working as designed for educational purposes. And that brings us to the end of our breakdown of directional coherence emergence. We covered the original idea behind it, turning the alternation count of recent bar returns into a single measure of directional order. We saw how it waits for that order to emerge through a self-calibrating barrier, how it trades in the direction the order points, and how it manages risk with an ATR-based stop and a target that stretches with the strength of the move. If you found this walkthrough helpful, please give the video a like, leave a comment with any strategy you'd like us to analyze next, and subscribe so you don't miss what's coming. You can find more analyses over at www.algobot.live. Everything here is educational content only and not financial advice. Past performance does not guarantee future results. Trade responsibly.